It's hard to figure out how to do this, Tom. I mean, what are you using and sort of what is your framework as a strategist and as an analyst to figure out what's important to the market right now?
Hey, Oliver, thank you very much for having me back on again. This market, Oliver, is all about multiples, which for a lot of non-professional investors is a bit of a strange concept. But essentially, really what the market is figuring out is what multiple of next year's earnings should stocks trade at. Right now, they're pushing towards 20 times next year's earnings, which incidentally is near historical highs. So this market has priced in a lot of good stuff happening. And whenever we get even a little bit of bad news, like we did from Apple this morning, you're going to see some weakness.
What's the best explanation for it, Tom? I mean, there's a list of them. There's the, it's all about liquidity in the Fed, but the balance sheet expansion has stopped for now. We know that there's expectations for a cut that's built into the bond market. But as I've observed here, the VIX has been almost directly tied to Fed cut odds. So just like this morning, Fed cut odds are up, stocks are down. It doesn't seem terribly obvious to me at this point that stocks are begging for a cut.
Yeah, I don't think they are begging for a cut because I think the Fed will only cut if we see further economic weakness, which frankly nobody wants at this point. But what I think the market is betting on is that essentially the Fed put is in place, right? Where if things start to turn south like they did last summer, the Fed will be extremely aggressive. Additionally, this is important coming out later this summer. Nobody's talking about it yet, but people are going to in the next couple weeks and months. The Fed may come out in the summer and do kind of like a review of its policies over the past couple of years and essentially say that they are going to let inflation run hotter than they have at any point in the last 30 years, which guess what? That's typically beneficial for stocks. So the Fed is dovish. I think the market believes the Fed put is in place. It doesn't want a cut, but it knows one is there if it needs it.
Right now, there's a lot of focus on the China risk and the economic fallout from coronavirus. In Europe, we got a pretty rough drop in the German ZEW survey from a big pop last time. Their numbers have been pretty ugly, not just Germany, but the whole area over the last couple weeks. How do we assess kind of what the biggest marginal economic risk is? What's most relevant to the U.S.? Right now, it seems like, once again, we're just far and away like in our own world of strength.
Yeah, it's kind of bizarre, right? That the U.S. economy just continues to kind of chug along, not at spectacular growth, but it's a pretty good economy right now, despite the rest of the world being a bit of a mess. And that's really what investors need to focus on. If the market begins to believe that the rest of the world will drag the U.S. economy lower, which incidentally is what it started to believe in the summer of last year, then all of a sudden you're going to see this market trade with a lot more volatility. But as long as investors believe that the U.S. can kind of continue to chug along, even if there's slow growth in the rest of the world, then stocks should be okay. And the key, of course, is how big is the fallout from the coronavirus. Right now, the market seems very confident that this is not going to be more of a fallout beyond the second quarter. If that opinion changes, look out, this market's going to get volatile.
I think that, again, we have this tension, right, where we've got stocks looking very hopeful. They're looking for the earnings growth. Bonds, we're going to be opening up today after this morning's bond rally in inverted territory for the 10-year to the 3-month yield again. The bond market saw last year was able to force Powell's hand. But unless there's real deterioration, is that going to happen as easily? I know right now in a period of concern, Tom, it seems weird to ask about, risk to bonds and the safety trade, but it seems like they're trying to do a repeat of 2019. And what happens if they don't get it? I mean, what happens if Powell says, you know what, I can't cut because of coronavirus unless it's really, really obvious that it's going to drag here?
Then you're looking at a repeat of May and August of last year, which were obviously the two most volatile months of the year. I agree with you completely. We're sort of like in an absurd world, right? All the economic data is pointing to slow growth, potentially growth rolling over now with the coronavirus. Meanwhile, stocks go up every day and hit new highs. It's like they don't care. Well, it's not that they don't care. It's that stocks in this environment of very low rates, a Fed put, a very stock-friendly administration, unless stocks are convinced that global economy is going to roll over hard, they're going to keep rallying. Now, that doesn't mean it can't happen, and I cannot agree with you more. What's going on in the bond market is extremely concerning for anybody with a time horizon, 6 months and beyond, which is pretty much all of us, right? But we're so focused on the day-to-day, it's hard to kind of keep track on that. We need the bond yields to start going higher. We need the 10s-2 spread to start steepening to really validate what stocks are saying over the longer term.
What do you think would be a sign? What do we look for? Is it a bad print? Is it another big guidance cut? I mean, what will sort of lock in that rate cut that bonds are looking for? I know it's hard to speculate, but it seems like it's one of the most important questions. If right now, clearly stocks aren't signaling it, our own data's not signaling it, what will kind of be the break? It seemed like in 2018, it was like a 20% drop in the market where Powell said, okay, I'll cut the rates.
Yes. Yeah, that certainly would help, right? Because at the end of the day, regardless of what the Fed says, they know they have to support the market. And that's just the reality, the practical reality of it. I think it's international, and I think it's inflation. I think if you see inflation start to move down again, the Fed could cut. I think if international growth rolls over hard, especially in China, you could see the Fed preemptively cut and essentially say, hey, things aren't so bad here in the U.S., but we're worried about the fallout, so we're gonna preemptively cut. 10 years ago, I would have said that's impossible. They'd never do something like that. But this is a different Fed, and they want stocks up, regardless of what they say. They want stocks up, and that's one way to do it.
Does the 2.5% CPI we saw last week then complicate it? I mean, is it a crazy notion to think that this will, this periodic, or temporary risk will fade, and then that trade from last year will come back on? I mean, I don't think there's a lot of people that are really betting on that right now, but is the risk reward worth it to still dabble in banks, to still dabble in industrials that looked like they were trying to get on their feet last quarter? I mean, CPI was pretty hot.
Yeah, I think over the longer term, yes, it is. I mean, if we're looking for value, right, those are two sources of value in what is otherwise an extremely expensive market. And the one thing that no one is expecting right now, which is always something we got to keep an eye on, is a surprise in inflation. Now, that CPI number, that would have to get over 3% because it sort of overstates inflation compared to what the Fed normally looks at it. But that would have to get over 3% to get the Fed to act. But just you always want to look in your rearview mirror and not be blindsided. Inflation is something no one's betting on, and boy, that would turn this market upside down real quick.
Yeah. So right now, is there a breakdown in terms of allocating just for cash, for safety? Walk me through sort of what you guys are viewing at the Sevens report and what you're talking to clients with about right now. Do you keep money on the side, or do you put it to work somewhere? Do you just say, look, I'm not going to fight, the trend. I'm going to hold bonds. I'm going to hold growth stocks. Where do you see that kind of risk reward right now, Tom?
Sure. So we view the market overall as a hold, and we have for some time. So we're sort of enjoying the ride. We're not over allocating the stocks beyond what we typically do. We're not being aggressive into stocks at these valuations, even though the market is so strong. For money that we do need to put into the market, we're going into defensive sectors. We're going into utilities, REITs, staples, healthcare. And then if you want to sprinkle in some super cap tech, the FANG names, sure, they almost take on sort of defensive properties. But we're staying pretty low on the risk curve, and we think that's appropriate simply because, Oliver, if one thing goes wrong, if we get a growth scare, if we get an inflation scare, if all of a sudden the Fed says, hey, economy's doing much better, we may actually, the next move might be a hike, then you're talking about a 10% correction in this or pullback in this market in a hurry before we even get close to what is, more historical long-term support. So that makes us a little bit uncomfortable, not uncomfortable enough to sort of underweight stocks at this point because the market is so strong and you have to respect it. But we view it as a hold, and we're sticking in the more conservative defensive sectors.
That sounds like Friday's going to be a busy day to watch the PMIs when they come out. Just real quick before I let you go, Tom, Apple obviously has been a huge winner within the big tech cohort. Is this going to be the prick to pop the bubble here? Not to use the B word on Apple, but the thing has gone wild and exponential almost.
It has, and I think this is going to come as a bit of a shock because everybody expected that the coronavirus would hit Apple. I don't think they expected they would hit it quite this hard. And sort of the big issue is that Apple didn't give us really good updated fiscal year guidance. So now everybody's kind of lost in sort of a wondering game, and that's never a good thing in the markets. That said, there's so much money that wants to get into these names. I think it's going to take something more than this to really prick that FANG bubble, that super cap tech bubble. And this could be it, but I don't think it's it yet. I think we need to see more.